Hi, everyone, and thank you for joining us today. We are going to go over the various federal retirement benefits that you have. Um, my name is Stuart Hunsicker. I'm with Federal Pension Advisors, and we're going to cover the FERS and CSRS systems today for you, as well as your other retirement benefits. This is going to be a 10,000 foot level, as I like to call it, or a very high level of how the benefits work. It's not going to be very specific to each of you individually, as that would be difficult to do in a structure like this. However, anyone attending today does have the ability to get a free, no cost, no obligation one-to-one review to basically see exactly what your benefits are going to look like in retirement specific to you. So we'll mention that again as we go through, but at the end of the session, you'll be able to click in and opt into that if you'd like and set that up. And again, that's no cost or obligation to you. Get a full benefits report to kind of show you everything at your level, how it works, and what you can expect as you get into retirement. So, with that, one other sort of tidbit to get out of the way here. Nothing that we're going to discuss today should be interpreted as financial advice. The only person that could do that is going to be someone who is a financial advisor and is fully aware of all of the details of your particular situation, not only the federal benefits, but your other accounts that you have, your goals, both for income, legacy, survivorship, all those types of things. So those have to be known in order to give proper financial advice. So please understand that nothing today is going to be specific financial advice to you, but more of, like I said, an overview, high level of how the benefits work. And so with that, we will kind of get started here. So this is my information and our contact information here at the bottom. And as I mentioned earlier, you do have access to one-on-one consultations, retirement calculations. Uh, at that website there, you can opt into it. And again, we'll have options for you later on as well. I'll pause here for a second in case anybody wants to write that down. All righty. Federal employee benefits. So today we're going to cover CSRS or FERS, how to know, if you don't know which one you're in, how to identify that. And then they work a little bit differently with each other. So we'll touch on how each of those work um, from a contribution standpoint as well as a distribution standpoint later on. We'll touch on survivor benefit options, FEGLI, Thrift Savings Plan or TSP, Social Security, Medicare. We'll touch on that as well lightly. Your FEHB or your federal health benefits. We'll touch on long-term care and briefly on how taxes kind of come into play in retirement for you as well. Very important as it is different than while you're working. So CSRS or CSRS, as you'll hear it called, and FERS, you'll hear them referred to as annuities. They are your annuity or annuity benefit. They are a pension system, but the federal government chooses to call them annuities. Basically, which one you're in is going to really come down to when you were hired. So if you were hired prior to 1984, so anything prior to 12/31/1983, you were going to be in the CSRS system, most likely. If you were right on the threshold of that, you could be a CSRS offset or other variations that they had. There was a little bit of a transition period depending on whether you had 5 years of service going into FERS or at the end of CSRS. If you did not, then there is a kind of a bridge option that they gave people at that time. So again, generally speaking, though, if you were hired, before December 31st, 1983, you are in the CSRS or CSRS system. If you were 1984 or after, you were almost certainly in the FERS system. So the way that these pension plans basically calculate your benefit is they take what's called your credible service. And so that's how many years of full-time service. Some of you may know that as what they call regular, that you were regular benefits contributing, benefits eligible service time. They're going to calculate it basically years, months, weeks, and days from the start date, which they call your service computation date, all the way up till the last day you work. And so that is your credible service. This can generally be found. There's two versions that you'll have. One is called a leave SCD, and that one is located on your leave and earnings statement, pay stub. It's usually towards the top. If you've basically never had any extended leaves, where you maybe went out on, leave for a couple of months or maybe even years, or basically, gaps of employment, generally your leave SCD is going to be fairly similar to what they call your retirement SCD. But if you do have any of those other things that come into play, there is a chance that your leave SCD and your retire SCD could be different. The one that's important to know is your retire SCD. That is the one that really is what they use to calculate your pension benefit. And you can find that in most of the payroll systems that you have. HR can also tell you what that is, but that is a very important date to know. It should also be located on most of your SF50 forms. So if you have those, you want to maybe reference that as well. I'm very big on making sure you have physical copies of your SF50 forms and all of them. So if you don't have those, you do want to try to log into your your electronic OPM file and pull those and keep copies for yourself, because there are times that OPM's records may not match up to what you feel that you've worked. And OPM's stance on that is you generally have to prove what you worked when it comes to calculating your pension benefit. I know that probably doesn't make sense why you would have to prove to your employer when you worked, but unfortunately, OPM still works off paper files, and they're located in a cave, physically in a cave in Boyers, Pennsylvania. So there are times that things get misplaced, let's just say. So I am a big proponent of making sure you have physical copies of your SF50 forms. And again, that can be filed in your EOPM file, uh, any of your electronic personal records. HR might probably can also get them for you if you don't have them. But going back to the calculation, it's credible service times what's called your high three salary times percentage of pay. And I'll dive into each of these components a little bit more in depth here. So credible service, as I mentioned, that is your essentially your full-time start date to the date you physically retire, plus any military service time that you elect to purchase. So if you served and maybe you did 3 or 4 years, not enough to qualify for a military pension, military retirement, then you have the ability to buy that time to get it contributed to your federal retirement. And what you do is you work with HR, who works with OPM to get a cost estimate for you, and then they actually can spread that out through multiple pays on your payroll to get you paid up. It's usually a pretty good idea to do that, because in most cases, what you made during your military time is probably a lot less than what you're making in your federal work, and so it's usually not that expensive to buy the time, and the benefit that you would receive from it is almost certainly worth substantially more than what you would be able to purchase it for. So definitely something I recommend there. And then when you retire, they also take and calculate how much unused sick leave you have. And so that unused sick leave is based on a 2,087 hour year, and it breaks down to about 5.89 hours per day. So I know that sounds like a weird amount, but it doesn't take 8 hours as you would think to equal one day. It's actually 5.89. So what you'll see is that it's if you look at the chart that's out there, which there's the charts actually on OPM, but it's 6 hours is one day, 12 hours is 2 days, and it's 17 hours is 3 days. So you'll see it's not quite six to convert. And so again, what they're going to do when they go to calculate all of your time is they're going to basically kind of line them up. So they're going to take the exact time that you worked. They're going to add any years, months, weeks, and days of military time you have that you bought. And then they're going to do the same thing with your unused sick leave, and they're going to kind of have them 3 lines, and then they're going to add them all together. And what they're going to do is they're going to pay your pension, your annuity is going to be based on the years and months of work that you have completed. They do not pay you for weeks and days. So it's important to know, as, or even hours for that matter. It's important to know because as you get close to retirement, you can sort of ballpark roughly what you're going to get credit for. And then if you have an extra couple of hours here or there, you might want to use them because you won't actually get credit for them. Now, this is different than annual leave, so be sure that you kind of keep that in mind. Annual leave will get paid out to you in retirement somewhere between 6 and 8 weeks after you're retired. And so that comes as kind of a lump sum check for you. Things that count incredible service for you, again, date of hire to retirement date, unused sick time, purchased military service time, uh, some things that you um, kind of subtract out of it, if you will. So if you have time that you didn't contribute to the pension system, that may not count. However, they may also offer you the ability to redeposit that contribution to get the time to count. And then some things here on the right, you'll see leave without pay, um, part-time service, intermediate time, basically anything where you're not contributing to the pension out of your paycheck does not count towards your calculation. And this is just an example. They have your 1,000 hours of unused sick leave will get kind of added for you. And so this is an example of kind of what I was talking about, how they break it down. So this is your retirement date here, December 10th, 2024, hire date of 2/9/1994. That's 30 years, 10 months, and 1 day. Let's say you had 4 years of military time that you bought exactly. So you put that in there. And then 1,000 hours of unused sick leave, which calculates to 5 months and 23 days. So they add all these up, which gets you 35 years, 3 months, 24 days, and you'll see the 24 days gets dropped. So they pay you for 35 years and 3 months of time. Hopefully that makes sense. So again, your SF50 forms, this is your notifications of personnel action. So this is basically every position you've had in the government. One of these is generated. And you generally want to, again, keep a copy of these because when you go to retire, you may have to prove how much you've worked. Hopefully not, but just in case. So this is how much it costs you to buy your military service time. Uh, Basically, 7% of military pay has to be deposited for CSRS employees, and it does typically include some interest in there. If you're in the FERS system, it's 3%. And mainly the reason it's a different amount, in case you're wondering that, is that the multiplier uh, for your benefit on CSRS is higher than it is for FERS. So because you're contributing more to it. Best day to retire is a question I generally get. Um, Essentially, what happens here is that your annuities start at the beginning of a month. So what you want to do is try to retire towards the end of a month. Um, and the main reason for that is you want to think of the time that you're going to have from your last real paycheck to your first pension check. And so if you're retiring towards the end of the month, then you'll still get your normal every 2 week check, maybe mid the next month. So, for example, let's say you retired December 30th. So somewhere around January 15th, you're going to get your normal paycheck for the last couple of weeks you worked in December. And then what'll happen is February 1st, you're going to get your first, roughly around February 1st, you're going to get your first pension check. So if you didn't retire at the end of the month and say you retired around the 10th of the month, well, you're going to get the check at the end of December, but then you're not going to get your first pension check most likely until that February 1st date as well. So you may have an entire month in there where you're not getting paid. So generally speaking, most people do retire towards the end of a month. And more often than not, I would say the highest percentage of retirees tend to retire in December. In terms of like if there's one given month, that tends to be the biggest one for retirement. Your high three salary is not actually 3 consecutive years. I know that's what it says here. on the slide, it's actually your highest 36 consecutive months. And so what they do is they will literally look at your different pay grade for your highest, essentially 3 years, right? They have to be consecutive. They do not have to be your last three. So if, let's say, for example, you have a higher position early, at some midpoint of your career, and you decide to take a step down or maybe relocate to somewhere that doesn't get as big of a locality pay, then theoretically your ending salary may be lower than what you made a little bit earlier in your career. So they will use those highest three. Doesn't really matter uh, when they occur in your career. It's just they do have to be consecutive. But let's say, for example, you have 5 months at one pay, and then 17 months, let's say, at another pay, and then 14 months in that third pay. Well, they literally will calculate each amount at that tier on a month by month basis, add them all together, and then divide by 36 months to get your monthly average, essentially, um, and then times 12 to get that annual amount. So hope that makes sense. It's not a huge difference between essentially what high three would be, but just the nuances of how they do exactly calculate it. All right, retirement eligibility. I like to call these checkpoints. So they're a little bit different depending on which system you're in. So if you are in the CSRS system, your checkpoints are age 55 with 30 years of service. Uh, you do have to have both. Okay, so it's 55 and 20 won't work for full retirement benefit. But 55 with 30 or more will qualify. 60 with 20 years of service qualifies, or age 62 with at least 5 years of service qualifies for a benefit. So very important to know those checkpoints, if you will, because depending on which one you hit, you are physically able to retire at that point if you want and receive an unreduced retirement benefit. And keep in mind that these are all voluntary retirement, meaning you're electing to retire on your own. You're not forced out or given an option to early out. If they force you out or essentially try to buy you out, um, then usually they waive the age requirement or the years requirement and just calculate you in full benefit at that point. But that's going to be up to the offer that they're willing to make you. But that's kind of normally how it goes. But without that, again, voluntary retirement, CSRS 55 and 30, 60 with 20, or 62 with 5. Now, I would imagine that most folks listening to this are going to be in this FERS category. About 95% of active employees are in FERS now. Again, mainly because of that 1984 uh, start date. But FERS, this one works off of what they call MRA, or minimum retirement age. So for most of you, that MRA is going to be 57. Um, Depending on the year you were born, it could be anywhere from 56 to 57 if you're in your 60s already. But that minimum retirement age, or MRA, again, is if you have that, let's just use 57 in as example, and you have 30 years of service, you qualify for the full retirement, unreduced retirement benefit at that point. If you are aged 60 with 20 years of service, you qualify, or age 62 with 5 years of service. This is that MRA schedule. So again, depending on kind of when you were born. So before 1948, your MRA is age 55. After 1970, your MRA is 57. And so you can see, depending on the year you were hired, depends on kind of what your mark is. So I'll pause on this screen. If you are in that category, just sort of look at your number, maybe write it down, and kind of put that in the back of your head that is your age requirement for minimum retirement age for retirement with a full benefit. If again you have that and 30 years of service. This is the early out formula or RIF, retirement eligibility. Again, they have to kind of offer it to you. You can't just say you want to take it without an offer. but CSRS can usually go out at 50 with 20 years or any age with 25. And FERS minimum is that minimum retirement age with 10 years of service, um, with at least 5 of those years as a FERS employee, or age 50 with 20, or any age with 25. But again, this is the early out. Um, if you're not offered uh, or forced out, there is you can still go with these ages, but there would be a reduced annuity, which is what you're seeing here in red. So again, this is sort of summing up the most of what we talked about before. However, the one thing I do want to point out here is that if you are at your minimum retirement age and FERS with at least 10 years of service, but not 30, so more with 10 or more, but less than 30, it's a 5% reduction per year that you're short of age 62. So for example, let's say you're 57 and you have 20 years of service and you want to retire. Well, they will they'll calculate your benefit, and then they'll deduct 5% for each year you're short of 62. So if you were 57, that's 5 years short. 5% times 5 is a 25% reduction in your benefit. So pretty hefty hit. You do have the option though that, let's say for example you were 57 and 20, and for some reason you didn't want to continue to work, whether it's just burn out, want to do something different, or some kind of family thing comes up and you need to leave. You can, if you don't want to take the reduced benefit, you can defer your pension payment until 62. So essentially, what you're doing is you are postponing receiving it. However, be aware that you do not carry your health insurance or FEGLI benefits during that period of time. So you want to keep that in mind. That's usually very important for people. But if you have health insurance somewhere else, maybe through military time or through a spouse, that might not be as important to you, and then you could then leave and defer your receiving your pension check until 62, so that way you get the benefit in full without a reduction. Disability retirement is any age with 25 years of service. You can go out with a full disability retirement. However, if you qualify for disability retirement, it's a bit of a complex formula. They do require you to apply for Social Security disability. And the reason is that your benefit can be offset by, at least in some fashion, offset by your Social Security disability benefits. So that is why they require it, that you apply for it at least. Now, it doesn't mean you have to be approved for it, but you do have to apply. Please note this is not disability insurance. The federal government does not provide you all with disability insurance. This is disability retirement, so they are different. Um, so something to take note of if you are concerned about disability coverage. Especially if you're younger, have kids. You don't want to have the issue where you're maybe playing in the yard and get hurt and have to miss a chunk of time, and not have disability insurance to kind of replace your income during that period. So something to definitely be aware of, that as a federal employee, they do not provide you with that. Please note that these ages that we've talked about exclude air traffic controllers, law enforcement officers, firefighter retirements. Um, you'll hear these referred to as special provisions. So they have their own kind of set of rules, which we'll touch on as well. Special provisions. So right into that here for you. So LEOs, law enforcement officers, firefighters, air traffic controllers, they have voluntary retirement ages that are different. So can retire at age 50 with 20 years of service, or any age with 25 years of service. And the main reason that this is done and offered to you is that your career is usually considered to be um, more taxing, maybe life threatening, for example. And so you're actually forced out of your position generally by 57 for Leos and firefighters, and 56 with 20 years of service for air traffic control, unless you were to move into a supervisory type position there. So there are some some things you can do, exceptions to the rule to extend that, but in the chair, so to speak, for air traffic control, it is forced out at 56. And that's a safety thing, is kind of the reason for the firefighters and air traffic control. So we're going to touch on kind of how your contributions work because this has changed over time. So CSRS employees, as we mentioned earlier, contribute 7% of their pay. When they switched over to FERS employee, to that setup in 1984, they went with that same 7% of pay. However, only 0.8% of it actually went to the annuity and 6.2% went to Social Security. Now, you might be saying, well, hey, why is that? Well, CSRS employees, while they had a higher payout ratio on their multiplier, if you will, for their benefit, they did not contribute to Social Security and therefore are generally not eligible for Social Security. Even if they had worked in some other career that did contribute to Social Security, they still could be subject to what's called a pension offset or Social Security offset that would reduce that benefit as well. So, it's not always better just because they have a higher multiplier. There's a lot of factors that go into kind of which pension is better. But CSRS, again, 7% did not contribute to Social Security. And what they happened is really the reason that they created a new pension system for FERS was that Social Security was struggling. It was underfunded. And, they tried to figure out how do we get more money, going into Social Security. Well, federal employees make up one of the largest groups of employees in the country. And so they said, hey, what if we change the pension system, had them contribute? And so they felt like that would fix Social Security. And so that's what they did. They switched you guys to FERS. Still the 7% going in, but again, 6.2 of that went to the Social Security system to try to save that. And it did. For the time being, anyway, it saved it. Obviously, we're in a little bit different situation today, but back then, this was a good fix. Now, that did change. So there was a FERS uh, revised annuity that was created um, back in 2013. Didn't last very long, but the contribution, instead of being 0.8% going in to your pension, it was 3.1. And the reason they changed it is that the pension actuaries, came to the government and said, "Hey, you're not putting enough money in the system to sustain the payouts you're promising employees." And so, they had to go back to the drawing board and figure out, okay, well, how much do we need to have them contribute? And so that amount was changed to 3.1%. It was then revised 1 year later and bumped up to 4.4 because the 3.1 was apparently not a good number. It wasn't enough. So anyone hired again from 2014 on is at 4.4% for the annuity itself. That's a further revised annuity. And then it's a 10.6% in total comes out of your check. That's the 10.4 plus the 6.2 for Social Security. Now, on your pay stub, your leave and earnings statement, most of them will either say FERS or retire and have that contribution showing for the 4.4 amount. And then the Social Security is going to be listed as OASDI. Now, special provision employees, again, air traffic controllers, LEOs, firefighters, they contribute 7.5% of pay. So it's 1.3 for the annuity and 6.2 for Social Security. So we'll start with how to calculate the CSRS annuity. So it's a little bit complex, so I will leave the screen up for a minute in case you want to write it down. But for the first 5 years of your service time, they take that, it's 1.5% times that high three salary times the 5 years. Then what they do is they take the next 5 years and do the same formula, but they're using 1.75% per year. And then anything above that first 10 years is now going to be at 2%. So the system here is really designed to reward you for longer working time. Now there's a max annuity of 80%. So, that's someone that's going to be putting in probably 42 years roughly. Um, nice payout, 80% of your high three. And then they can add unused sick time to that as well, to get a little bit extra on top of it. So, pretty healthy pension benefit. Honestly, at that rate, your bring home is essentially what you were making before taxes because they're not withholding the pension money anymore. So under the CSRS annuity with an early out, the calculation is reduced by 2% per year that for each year under retirement age 55. Now, I know that's a little bit confusing. Please, if you're a FERS employee, don't confuse this with yours because that one's 5% per year under 62. This is 2% for each year under 55. So when they switched to FERS, again, just to sort of rehash the history here, they started to view your retirement as a three-legged stool. So the first part of that stool is the FERS annuity itself. The second part is going to be your Social Security. And part three is the TSP.